Each year, Vanguard releases its eagerly awaited forecast on the future of the stock market, and this year's report is significant. They predict that the next decade may not be as good as the last, offering surprising insights on stocks and bonds that could have implications for your investments, particularly for retirees. So, should you be concerned? Is it time to revise your strategy? In this video, we will delve into 3 critical market expectations: higher interest rates, opportunities in the bond market, and Vanguard's outlook on equities. Vanguard is predicting a major shift that will extend beyond the current economic cycle, and it is particularly good news for retirees. They describe it as the most significant financial development in years. But before we dive into those details, let's first understand Vanguard's insights on how interest rates will impact the global economy. The Fed starts to cut rates in 2024, with more cuts likely in 2025. However, Vanguard says zero rates are a thing of the past. Higher interest rates are here to stay, even after policy rates recede from their peaks. This higher rate environment will last for years, not months. So to make it simple and give you a rule of thumb here, when interest rates rise, borrowing money becomes more expensive, which can slow down economic activity. This means we won't be seeing those days of cheap money where you could get a mortgage at a 2% rate. For households and businesses, high interest rates will limit borrowing, increase the cost of capital, and encourage saving, affecting not just individuals, but businesses and governments as well. So how will long-term high interest rates impact people who invest in bonds? Vanguard says bonds are back. This means investing in the stock market won't be the only good option, and saving money will become more appealing. For example, in Europe you can now get a 3 to 4 interest rates on your saving, fully protected and guaranteed by the government. This makes saving much more attractive compared to a few years ago when rates were under 1%. And professional asset managers will also find these guaranteed returns on safer investments more appealing, which could lead to a decrease in stock prices as they become less attractive. But what does this mean for bonds? Could this be the opportunity bond investors have been waiting for? So short-term pain can lead to long-term gain for bond investors. Despite recent losses due to rising interest rates, high interest payments are boosting future returns for bond investors. Higher interest rates have made recent years tough, but now offer better long-term returns, expected around 5% annually for UK and global bonds. This rise in rates is great news for bond investors, providing a solid foundation for future gains. So Vanguard's forecast is especially beneficial for retirees with withdrawal plans. Higher expected bond returns provide a more reliable income stream, reducing the need to sell stocks during market downturns. This stability helps protect their portfolio from volatility and ensures more consistent and secure withdrawals. The potential return of the 60-40 portfolio, 60% stocks and 40% bonds, offers a balanced approach combining growth and stability with an expected 7% annual return, making financial planning more predictable and less risky. Now let's address the big question. What does Vanguard think will happen to the stock market over the next 10 years? Vanguard believes most of the stock market, especially US stocks, are overvalued right now. However, they see value in emerging markets and US small caps. While predicting an annual return of 3.3% to 5.3% for US stocks over the next decade, they expect global stocks minus the US to perform better, with potential gains up to 8.7% per year. So to put this in perspective, the last 10 years saw US stocks returning an annualized rate of 12%, well above the long-term average. When you are investing in the S&P 500, the biggest companies you hold are in the tech sector, which have done a really great job. However, with the prediction of higher interest rates, the dominance of the tech sector may wane. This could lead to a shift towards sectors like consumer staples, which tend to be more stable in a high interest rate environment. Similarly, we might see a shift in investment focus from the US stocks to other international markets, seeking new growth opportunities. Remember, these predictions are just model based on probabilities, because no one can predict the future perfectly, not even Vanguard. For example, in 2014, they predicted the global stock market return of 5 to 8% annually, but the actual returns were much higher, around 12%. This unpredictability shows that markets are just educated guesswork. So an historical reminder, for example, in the late 1990s, people feared computers would crash due to the Y2K bug. So they were worried about zero double digits for the year 2000 would be read as 1900, causing major problems. Government and businesses spent billions fixing this issue, but when January 1st, 2000 came, there were no major problems. This shows how serious concerns can lead to exaggerated fears. So it's better to be prepared for various outcomes rather than rely on specific predictions. The key takeaway here is that the future is unpredictable. So unforeseen events like financial crises and market booms can drastically change outcomes. That's why diversifying your investments is crucial. By spreading your money across different sectors and asset types, you reduce the risk of significant losses from any one investment. Diversification helps protect your portfolio and ensures more stable growth over time, regardless of market conditions. So the problem with diversification is that there are so many ETFs to choose from, it can be overwhelming, right? So if you are feeling confused or unsure, you are not alone. In this video, we will dive deep into the pros and the cons of different ETFs to help you find out the perfect fit for your investment goals. So don't miss out, watch now to make an informed decision and feel confident about your financial future.